Okay, welcome once again to Financial Accounting Revision by Coach Samuel Ibanda. We are here to get ourselves ready for the upcoming exam, and we're trying to cover different questions around areas where we feel we have challenges. And the current challenge that I'm trying to comment about is from one of us, which says that they are wondering, when you're preparing contra accounts, what do you choose to take to the P&L? And my comment was that when it comes to contra accounts are either for accounts receivables or accounts payables. So a contra account for accounts payable, account receivable, of course, this can be, sometimes they can call it a sales ledger contra account, sales ledger contra account, or it can actually be called a debtors contra account, whatever name they may call it. One thing that you need to understand, that sales and receivables go hand in hand, and more so when it comes to credit sales, because when you sell on credit, we get accounts receivable, which are sometimes called the debtors. So these contra accounts basically are there to give you an alternative balancing or reconciling of what exactly goes in the accounts receivable account. Also to just remind you that when we are looking at contra accounts, in mostly these contra accounts will always come, the examiner will give you balances, and most of the balances they will give you, for example, for accounts receivable, will actually be the balances that you input into your contra accounts. They are basically balances for accounts receivable, but we still put them in the contra account, or whatever you might call it. Now here I'm calling it the sales ledger contra account, but it's also the debtors contra account, or it's the account receivable contra account. Everything around that. And when it comes to accounts payable, it can be called the purchases ledger contra account. It can also be called the accounts payable contra account, like that. So with this, we're able to know that for the sales ledger, or debtors, as they might call it, it usually has the balance brought down this side. Our balance brought down is usually on this side, while our balance carried down, our balance carried down is actually this side, because receivables are assets, and assets have a normal debit balance. So your balance will always be here, and the balance carried down will always be here. Now, in most cases, they'll give you these two values. They will give you these two values. What they will not give you is the information that you're going to look for. Now, in most cases, I usually say that when you're looking at the sales ledger contra account, you look at what increases receivables is on this side, and what reduces receivables is usually on the opposite side. And these can be very many, okay? They can be very many. I think I gave a format of how to prepare a contra account, but this is the principle. So you'll find what increases receivables are more credit sales. When you sell more on credit, it increases the receivables. What reduces mostly up is basically, since this is this is actually receivables, these will be receipts. When the receivables pay you, then they reduce on your receivable balance. So receipts from the debtors is actually what appears. So it appears this side, it also appears. We have what appears this side. So you can have more other items that might increase or reduce. For example, things like bad debts, you find them here. Things like returns, and by returns here, we're speaking of returns inwards, okay? And so also anything that could reduce your receivables is on the credit side. Anything that increases your receivables is on this side. So in most cases, you find that this balance brought down is given. For example, in this case, let's say maybe we have 10,000, and here we have, let's say 20,000. So you get the information that they have given you on each of these items. In most cases, of course, they will give you a few items, and let's say they have given us, maybe they have given us this value. So they have given us the receipts from our debtors. So if they give us receipts from debtors and we have the balance and brought down and the balance carried down, what we usually do is we usually get the total of each side. So I'll basically add up what is on this side to get my total here. And of course, just like any other ledger, I expect that as my higher side, which has the 23,000, it should definitely match with this other side. So ideally, this side should also have 23,000. But because it doesn't have 23,000, means that I have to get the balancing figure. So the balancing figure will be basically this minus the total of what is on this side. Now here I only have one item, which is the 10,000. So it means that 23,000 minus 10,000 basically gives me 13,000. So when you try to look at this, it now balances. Now some students make a mistake of again bringing a balance here or balance carried down. You don't have to, because you already have these balances. The balances have already been catered for. So this difference that you get between the two sides is not again a balance brought down or balance carried down, to name it. It's the credit sales. Sometimes the examiner can actually give you the credit sales, and what you're looking for is the receipts from the debtors. So depending on the scenario at hand, depending on which direction you're taking, when you're drawing up your ledger contra account, either it's a debtors or creditors contra account, then you need to know what exactly are you looking for, okay? So that is what I can basically comment when it comes to the amount to take. Like I said, if, for example, if I was looking for these credit sales, this is what I would get as my credit sales. But this does not mean that I transfer this to my P&L. Because in the P&L, what I'm looking for in the P&L are sales. And these sales need to be both cash and then the credit sales as well. So I cannot just take only cash sales or credit sales. So I have to, after I've gotten this 13,000, I'll look for my cash sales as well and be able to add. For example, if I have my credit sales as 13,000 and maybe I was also provided 15,000 as my cash sales, then I know that my total sales will be 28,000, and that is what will be here. But sometimes the examiner can say the company only deals with credit sales. So if that is the case, it means that my cash sales will definitely be zero, so they will not be here. So whatever you get from the contra account is exactly what I'll bring here. And that is how we transfer items. And that is the same thing that also happened with the purchases ledger contra account. Mostly what you transfer will be the credit purchases, okay? But like I said, depending on the question, the examiner can give you either this information or they can give you this information, and then you find what exactly you're looking for, okay? There are also even cases where the examiner will give you all this information, even including this, and what you're looking for is actually this balance, the closing balance of your debtors. So you just need to understand the concept of how these so-called contra accounts work. So that is one of the things. And then another person asked, manufacturing statement, especially factory assets, do we include their depreciation under manufacturing account or the trading account? Now, you need to understand that when we are looking at manufacturing accounts, Okay, when we are doing financial statements for manufacturing, yes, we have the manufacturing account, and then we have the trading P&L. Now, from the manufacturing account, the reason why we draw up the manufacturing account is basically to determine the cost of goods fully manufactured. The cost of goods fully manufactured. So for you to answer yourself on whether depreciation for the factory assets is included here, you should ask yourself, is the depreciation for the factory assets, is it part of the cost of my goods? Okay, for example, you use a machine to produce those goods. Is the depreciation of that machinery part of the cost of your goods? I would say yes, because the more we use that machine, the more it wears out. So the kind of the depreciation for such an asset that is used in the factory, it's to cater for its cost of depreciation. Then that depreciation has to be added when you're preparing your manufacturing account. So what exactly sometimes happens is, because when you're looking at a question of manufacturing, the examiner in most cases will bring you different assets, okay? And this is very common. The examiner will bring you different assets, and in one of those assets, they will speak of an asset that you should be able to relate to a manufacturing account. For example, if they say plant and machinery, in a manufacturing company, anything called plant and machinery, we know very well is an asset for the factory. So it means that ideally its depreciation should actually be taken to the manufacturing account. So sometimes they may not tell you that this asset is really specifically for the factory, but it's you to use your judgment and know that, okay, this asset at hand is an asset that is ideally used in production. So when I'm trying to do my manufacturing account, I should be able to include it also as part of the costs that I'm including in the manufacturing account statement. So that is what I can basically, so it should ideally be included there. It should be ideally be included because it is part of the cost of producing the goods. It wouldn't appear the other side, because remember the other side, we have three categories. We have the office and administration, we have the selling and distribution, and we also have what they usually call the financing costs, which usually takes into consideration the interest. So depreciation for factory assets can never fall under office and administration. It can never fall under selling and distribution, and it can also never fall under financing costs. So by all means, you need to know that it relates there. So like I said, even when it comes to, let's say, in the manufacturing question, they can also bring you a delivery van. Now, they may not easily say that the delivery van relates to the selling and administration, selling and distribution, sorry. But from your judgment, you should understand that if I have a delivering van as part of my assets, when I'm calculating its depreciation, then I should be able to take that depreciation under my selling and distribution, okay? So that's important. I see a hand up. Could you come through, Jacob?
Thank you, Coach. Good evening, everyone.
Good evening.
Before you leave the manufacturing account, I have a challenge with these things of markup, margin, and transfer price. I have a challenge on how to apply them. It's really giving me a hard time. I don't know if I think you can comment on that. Thank you.
Okay, you're welcome. So I was trying to highlight to you that when it comes to depreciation for the factory assets is part of the cost of goods fully manufactured, and so should be accounted for in the manufacturing account and not in the trading account. Like I said, the trading account records office and administration, selling and distribution, and then financing costs. So your judgment should be based on that. Okay. Now, as asked by Jacob, now, one of the things that I said when we are looking at the manufacturing accounts, I said, when you draw up your manufacturing account, what you get is called cost of goods fully manufactured. That is what you basically get, your cost of goods fully manufactured. Now, this cost of goods fully manufactured replace your purchases, because when you go to your trading account, the trading account, what you're going to do is you're going to start with your sales and less cost of sales and less your cost of sales. Now, we know that very well now that our cost of sales is calculated by doing opening stock, add purchases, which is the generic one that all of us know, and we less our closing stock. Now, you need to understand that when it comes to manufacturing account, when it comes to manufacturing company, we don't have this so-called add purchases. Reason why? Because we don't, whatever we sell, we don't purchase. Whatever we sell, we manufacture. So wherever there is the word add purchases, this is replaced by the so-called cost of goods fully manufactured. It is replaced by the so-called cost of goods fully manufactured. So this will be cost of goods fully manufactured. Now, that is one of the things that you need to first picture in your mind. That when I'm doing my trading account, this is one of the things that I have to look at. So if that is the case, there are organizations that want to create kind of, it's a motivation for the factory team, but its intention is also to get a picture to understand, what if we were buying these things that we are selling instead of manufacturing them? What profit shall we get? Like they want to evaluate and see what is the profit that we make from manufacturing by ourselves. So with that, they create an internal profit margin on the goods as they leave the factory to come to the sales side. And I'll use an example, for example, Coca-Cola. Coca-Cola is now owns the Renzoli bottling company. So I'll use the water. So water in the market, a bottle is 1,000. And they may be producing this water at, let's say, maybe total cost, the cost of goods fully manufactured for a single bottle of water at, let's say, 700. Now they sit and say, what if we're actually buying this water? What if it was, they were not manufacturers of water, but they were just buying this water from somebody? Maybe that somebody would label it for them, and for them, their role was to sell. So if the person who can give them that water, the market price for such a similar product, if it was being sourced outside, let's say it is 800, then they would make the 100, the 700 of what they are producing at, and the 800, which they can get from another person, that the difference, which is the 100, they look at it as a profit margin. So they call it transferring goods. They say they transfer goods from the factory at a margin or at a markup. Now, one of the things that you need to understand is what is a markup and what is margin. And you're going to use this information even when it comes to questions around single entry, okay? So before you go to the exam, you should understand what markup is and what margin is, okay? Now, we know very well that markup is a percentage of gross profit over cost of sales. Well, margin is gross profit as a percentage of sales. Definitely, of course, these have times 100%, because these are usually at 100%. So what exactly happens is that in most cases here, the examiner will give you the percentage, okay? For example, we'll say that maybe company ABCD transfers its goods at a markup of, let's say, 20%, okay? So it means that after getting from your manufacturing account, after getting that so-called cost of goods fully manufactured as it is here, you would then add a markup. Because for example, if you have, let's say, you have cost of goods fully manufactured, let's say, may use an example of 12,000. That is what you have gotten. And you've gotten this cost of goods fully manufactured by doing, of course, your direct costs, which are your prime costs. You add, of course, you look at your overheads, the factory overheads and so on. You've looked at things change in work in progress, added all that together to come to your goods fully manufactured, and you're coming to such a figure. Now, if they say you add a markup, so if you're adding a markup of 20%, in most cases, they'll give you this in percentage. If this is 20%, then you know that if you want to calculate markup and they say 20%, you just do 20% of the 12,000. So let's say maybe 20% of this. So you're able to get this value, okay? Now, one of the things that I commented about when it comes to, let's say, when we are transferring goods at a markup, I gave certain, I gave you, I think, within the notes, I gave you a guideline in terms of what you should exactly do. Because when you're transferring goods at fully manufactured at a markup, means that after getting your value here of your marked up goods, means that this is the figure that you're actually going to take to your trading account. You're going to take a figure that is already having a markup to it, okay? But one of the things that you also need to understand that it's not only these goods that you're transferring to the trading account. You already have opening stock of finished goods. You also have closing stock of finished goods. So ideally, you're going to find yourself that these ones also have to be marked up because your goods are now being carried at a markup, okay? So I don't know if we are following, and maybe to ask Jacob, what exactly confuses you? At what level do you get the confusion when it comes to the idea of markup? Jacob, could you comment? Maybe it will give me a good direction. If you're still on call. Jacob, I can't hear you. Maybe you're on mute.
Yes, please. Yes, please.
Yeah, I was just trying to ask, where is your challenge when it comes to the idea of markup?
Now, the challenge is what you transfer to, when you debit the POL or credit the POL. There is some element of when this increases or the other decreases, then you debit the POL, and it's just around that place. I just need to revisit the notes and read it out clearly, but I didn't understand when you debit, when you credit. I tried to read, but I didn't get the clear picture.
You read through the notes I shared.
Yes, I did.
So there are the ones you didn't understand.
The provision has increased greater than what, then you debit. If the provision is as reduced, then you just around that place.
Okay. Now, one of the things that I was still going, I was going to look at is that the reason why after we have looked at aspects of transferring goods at, let's say, markup, the reason why we bring in aspects of provision for, let's say, for unrealized profits on inventory, because ideally this profit that you're adding onto your goods is imaginary kind of profit, because it's profit that you have not yet earned. You only earn this profit when you sell goods to the final customer. But right now, what they are trying to create is an internal profit from the factory to the selling and distribution, which ideally would only happen when you actually sell to the final customer. Now, at the end of the period, because at the end of the year, you have unsold stock. You have some goods that you have not sold. But remember, you had transferred that stock at a markup. So because at the end of the period, you have not sold that stock, whatever profit you had added on that stock that you have not sold is unrealized. And that's why there's a provision. So when you're looking at a provision for unrealized profits, you look at your opening stock and then your closing stock. Here, by opening stock, it's also similar to me calling it inventory. So you're looking at the two and comparing to see, is the provision higher? Because you have two things. You have the opening stock and then you have the closing stock. So if, for example, let's say, let me give you an example. Apologies to those that are aware of this. Let me use inventory. Finished goods. Then we have closing inventory. Of finished goods. So in most cases, the examiner will give you these values, and maybe I'm going to use generic values. Let's say here we have 12,000, and here we have 24,000. Now, I believe that you know about, like right now we understand what markup is, okay? Like for example, what I've given you. Now, like I said, when you transfer goods at a markup, it does not only end there, okay? Because we are transferring these goods at a markup, there will be some goods that will remain unsold. So those goods that remain unsold, we have to calculate and see what is the provision on the unrealized, what is that unrealized profit on these goods, because if they have not been sold, means that we have not realized the profit. Like I told you, we only realize the profits when we sell to the final customer. So what we are supposed to basically do is we now have to compare the two provisions. Now, one, a provision account, we basically create a provision account. And we know very well that provisions have, definite provisions have a normal credit balance. But the provision is there to cater for that unrealized profit on your inventory. So we look at the closing stock as well as the opening stock. Now, one of the things that you need to understand is if the provision for unrealized profits on closing stock exceeds, okay, I repeat, if the provision for unrealized profit on closing stock exceeds the provision on opening stock, then we shall debit, okay? We shall debit our P&L, which is usually our trading account, okay? We shall debit our P&L. Now, I don't want you to cram this. Let's look at this. One, you need to understand how do you calculate the unrealized profit, okay? Now, if, for example, you are given goods, maybe what, like I've given you, this is what we have, 12,000, okay? And in most cases, these that you have here are figures that you need to calculate what is the profit on this. Now they can give you, let's say, a markup of 10%. So let's say we are working at a markup of 10%. So if you are working at a markup of 10%, means that if these goods, if this is the cost of finished goods, means that our markup on these goods would be 10% times the 12,000. So we'll have this, and then 10% of this is that. So if this is what we have, these are also, we are looking at them as the
Sir, we've lost you.
So I was trying to say that when it comes to now, let me just reshare my screen. When it comes to this is the same, what we call the provision for the unrealized profit. So this as opening stock was the closing stock of last year, and now this is the closing stock of this year. So that's why this is like our opening provision, and this is like our closing provision. So we say that if at all the provision for unrealized profits on closing stock exceeds, if this was exceeding this, then means that would debit our P&L, okay? It means that it's a disservice to us because we have remained with more than it was at the start of the period, okay? The reason why whenever they said debit P&L means that you expense the item in the P&L. It's another word of saying, because the P&L has, if you're doing it as a T, in the T format, which we usually don't draw these days, it has a normal credit balance because P&L is profit. Profit is equity. Equity has a normal credit balance, okay? So if they say you debit your P&L, means you put it under your expenses. And the same thing happens. Now, for example, in this case, okay, this case, again, we are seeing that the provision is decreasing compared to what we started with. Now, this is something that is of advantage to the entity. And in this case, this advantage, because the provision is reducing, just like the way we do for provision for bad debts. When provisions for bad debts are decreasing, it's more of an income. So we usually do what? We usually credit our P&L. So it's the same thing that happens here as well. So after you've calculated your provision on opening inventory of your finished goods, and you've calculated one on closing inventory of finished goods, you should be able to gauge between the two and ask yourself, is the provision reducing or it's increasing? Now here it is actually reducing. And what we do is we get basically the difference, okay? Because when you can actually, what you can do, you can do this in an account. You can draw up the account for provision for unrealized profits, and this will be your balance brought down, and this will be your balance carried down. So amount that you take to the P&L is the balancing figure, and more likely it will be the 960, which will be the difference between the two sides, the debit and the credit side. So ideally, that is what you would take to your P&L. And what you do when you're doing your P&L, after you've written your sales, definitely you do your less cost of sales, like what I tried to include here. Maybe just to clarify this again, your sales remain the same. Your opening inventory here of finished goods, this one will also have a markup. So you don't, if for example it was for this, you'll not see the 12,000 anymore. You'll see the 12,000 plus the 1,200. Basically, the value that has a markup onto it. Okay, this is the cost. But if you want to get the cost with the markup, it would be basically the summation of those two values to get the cost. So the cost that has a markup, the cost with markup is what you basically take. So you take the total of these two figures. Sometimes somebody can just get this figure and multiply it by, let's say if the markup is 10%, they can just multiply it by 110. So 110% would definitely get you to 13,200, which is the same thing as somebody who would have added 12,000 plus this, they would still get the same thing. So it would be the same thing here. So it means if I was to take, I would take this right here as my opening inventory. Right there. Sorry. That is what I will take. Then my cost of goods fully manufactured, I have had a sample here. So I'll take this. Let's say I'll take this 14,400. So I will not take 12,000. I'll take this 14,400 as it is there. That is what I'll basically take. Now let's closing stock. Again, I'll not take the 2,400, but rather I'll take this. Okay. The 26,400, that's what I'll basically take, and I'll put there. Okay, I hope we are seeing. Now, after this, I should be able to get my gross profit. Okay, let me just try to create my space and show you. If I have my sales, I should be able to get my gross profit. It can also be a loss. It's not that it should always be a gross profit, it can be a loss. So after getting my gross profit, again, I come and in case, for example, right now here I had, in this case, what did I have? I had, this was a decrease, okay? This was basically a decrease. It was 1,200, it is now 240. Now, in this case, this will be like an additional income. After my gross profit, I'll add, okay? I say I'll add the decrease in provision, okay? For the unrealized profits, and I will come and put my what? My 960 right there. So in case it was an increase in provision, maybe where this was my opening stock was less than this, then you get to see that that will be reflected even when it comes to here. So I believe that you get the concept, okay? Jacob, is that helpful? Jacob, could you unmute and confirm?
Sorry, come again.
Is that helpful? Have you gotten something?
Oh yeah, sure. I can build on that to understand.
Yeah, you can build on that. You can go back and read the text in case you don't have the notes. You can be able to get those from the admin. You'll be able to give them to you. But when you read through the text, it's clear, and you can see there's also an example there which you can use to build on. We may not be able to give you all the clarification here, but you can be able to build on from there, and it can be helpful for you.
Yeah, sure. Thank you, Coach.
You're welcome. All right. One of the other questions that came through in the chat box was somebody was asking, when do you take goodwill to the statement of financial position and when not? And somebody says this is for partnership. This is something that I wanted to comment about in partnership. So I'll first jump it a little. But just so you will know that goodwill is basically an intangible asset, an asset that you cannot touch. And when it comes to normal businesses, goodwill happens because of customer loyalty, where a company has been in place for a long period of time, it builds goodwill. So for example, when they are selling, they sell goodwill as part of the asset. So as goodwill is an asset that they look at. When it comes to partnerships, mostly goodwill comes in when we have, let's say, admission of new partners. Sometimes we can have how can I call it? We can have different, it's basically on general, goodwill comes in when we have changes in the partnership, okay? And most especially when we have new partners who are coming on board. The new partners that are coming on board mostly will pay a premium, and part of that premium will be to cater for the goodwill of those partners who have been around. Okay, but I'm going to highlight that a little more in detail in one of the questions that we're going to look at. So another person asked, I need more light on the statement of changes in equity. Now, I believe that most of us here, before I think proceed, Macklin has her hand up. Macklin, could you ask?
Thank you. I wanted to understand when you are talking about markup, I understand that one is subjected on sales. How about margin? How do we treat it? When do we consider it? Thank you.
Okay, just remain on. Do you see? Are you seeing my screen?
Yes.
Yes. Have you seen this that I tried to give here? I said that margin is gross profit over sales.
Yes.
You get it, times 100. Yeah. Now, I want to say that margin and markup have a relationship, okay? And even if you've not been given margin, or even if you've not been given markup, but you've been given margin, you can still be able to work around, okay? To, let's say, get a markup. And I don't know if you get the picture. If for example, if you have this information, if you have all this information, you have margin, you have your gross profit, you have your sales, okay? You cannot fail to find markup because all you need on markup is the gross profit and the cost of sales. But remember very well that gross profit is what? Gross profit is usually sales less cost of sales. Is sales less cost of sales. So if you have gross profit, if you have sales, you can't fail to get your cost of sales and substitute it here and you're able to get your markup. Do you get the principle, Macklin?
Yes, but also what I want to understand, if I find a question like maybe certain person makes sales on a margin, do I have to first convert it to markups, or I can straight away go and substitute it the way you worked on markup?
Now, markups are so much common when we are dealing with manufacturing accounts, because when we are transferring goods, remember the goods we transfer them, they are at cost level. We've not yet sold them. You get it?
Yeah.
So we've not yet sold them, so they are at cost level. When we are doing the manufacturing account, whatever we get is the cost. We don't get the sales. So we cannot use the margin. We rather have to use the markup.
Yes.
But if you're dealing with, let's say, mostly margin will be provided to you when you're dealing with questions of single entry, where, for example, they are giving you a retail shop that does not keep good records, and they'll give you, let's say, their cash book, they'll give you their margin, they'll give you maybe a sales figure, they'll give you different information. And from that, for you to determine some of the figures, you may need to apply the use of margin. With that idea, maybe you have the sales figure, so you want to look for the cost of sales, or you want to look for the purchases. You get it, eh? That is when you now start playing with the figures, because at the end of the day, you know very well that even as we have gross profit equaling to sales minus cost of sales, we know that this cost of sales can also be broken down to opening stock plus purchases less cost of sales. So you may find cases where you even using this margin to determine your purchases. You get it, eh? If you have information, for example, you have the gross profit, you have the sales, then you know that you can easily be able to determine even your purchases. You get the principle?
Yes.
Yes. So the dynamics usually do vary. And when you read through the question, if you understand very well what margin is and what markup is, then you can easily know how to play with the two formulas to determine what exactly you would be looking looking for at that time. But for specifically for manufacturing account that I've looked at, we usually use the markup. Just in case the examiner brings the margin, instead of giving you the markup, I've given you an idea. Work backwards to determine the markup by using the information that you have been provided. All right?
Yeah, thanks so much. That is much clearer.
Yeah, you're welcome. Okay. Yeah, so we have I was commenting on the statement of changes in equity. Now, one of the things that you need to understand that a statement of changes in equity is another financial statement. Just like the way we have the balance sheet, a statement of financial position, the statement of comprehensive income, the statement of changes in equity is another financial statement. I again say that when you're preparing your financial statements, we know very well that we start with the P and L, because the P and L will give us the profit. Then we move to the statement of changes in equity. I'm just trying to go in these details just to give you a background, and maybe this information would also help you. And then from the statement of changes in equity, we come to our statement of financial position. This is the order, because information from this goes to this, and information from here goes to here, and then we get to our statement of cash flows, okay? I'll be able to comment on the statement of cash flows. This is one of those topics that you will not find directly on the syllabus, but once in a while the examiner wants to test it, so it's an area that you take keen interest. So I'll just specifically comment on the statement of changes in equity. So the statement of changes in equity basically looks at equity items. And when I say equity items, I'm speaking of share capital. I'm speaking of share premium, which I basically understand that, but right now you must be understanding the difference between share capital and share premium. I'm speaking about general reserves. General reserves. You're looking at aspects of revaluation, things like retained earnings, and so on. Now, one of the things that I also commented about, I said that the statement of changes in equity, its format depends on the information the examiner has given you. There are some organizations that only have two items in their statement of changes in equity, and that is share capital and retained earnings. Now, share capital and retained earnings will always be in any organization, okay? At least a company has capital and has profit, because retained earnings is also called accumulated profit. Basically looks at the profits that you've been earning in the previous. So in terms of what goes there, now, The statement of changes in equity has columns, and columns are dependent on the information you provided. For example, if, for example, we have share capital being provided, so we have our share capital there, we'll have our retained earnings there, we'll have, let's say, let me just add one more. We shall have our share premium. So if this is the information we have been provided, okay, then these will be actually our columns. These will be our columns. Usually what we also do is we usually add total here. We usually add total here, and here we usually include, you can call it the detail, the details. This can also be, let's say, debt. Sometimes we can have the debt here. So the essence of our share cap, our statement of changes in equity is looking at how equity has changed over time within the year. So usually the first thing we start with are the balances. And these balances are usually what you've started with at the start of the year. What did you start with in terms of share capital? Let's say maybe you started with 1,000. What was your retained earning as per the end of last year, which is your beginning balance? Let's say maybe this is 5,000. What is your share premium? Let's say maybe this is 200. And then you have your total right here. So each column is added as it is right there. Then after the balance is brought down, because this is a balance is brought down, basically the balances you've started with. Now we look at the year, how it has happened. So we look at the profit for the year. Now profit or loss for the year will be brought in. Now if we've gotten a profit, you just come to the column of retained earnings and add the profit for the year. Let's say it's 1,000, and you add this column as it is, 1,000. Now, the other thing that you look at, in case there was any capital additions, share capital increased in the period, you say additions to capital. Maybe it's a sole proprietor business. If the shareholders contributed more capital, let's say maybe of 4,000, it will be there. You cascade down this side and you'll be able to get your total. The same thing will also happen when it comes to, let's say, maybe you've given out dividends. In case you have dividends, now dividends are given off the retained earnings because you've included your profit here. So even the dividends are supposed to be removed from here. So let's say the dividends are, let's say, maybe 4,000. You put them there. So you're going to remove, you are putting in a negative because they reduce. So you have your, this will be negative 4,000, even this side, because that's how the column is. And you'll be able to get the difference. Now, when it comes to, you can go on and on depending on what happened, okay? In case you have revaluation and there was a revaluation that happened, you record that. In case there was a transfer, one of the things that the examiner brings is a transfer to the general reserve. You can have a general reserve. So they can tell you that maybe a transfer of maybe 200 shillings was made to the general reserve. Now, money that is made, transfers that goes to the general reserve come from where? They come from the profits again. So a negative 200 can be from here, and then a positive 200 will go here under your general reserve. So you can have such cases. And then the last thing you usually have as the last column is total. Total that is adding up each of the columns. So you just have your total there. Even you get here as your total. Most likely, this will also give you the very similar total. Okay. So you just add this, and then you have your statement of changes in equity. So it has looked at all this. Now, when you go to your balance sheet, you don't have again to calculate these things. You just, when you come to your balance sheet statement of statement of financial position, when you come to equity as an items, just come and list, have share capital, and come and pick the 5,000, put it there. Retain earnings, come and put the 1,800, put it there. Share premium, come and pick the 200 and put it there. And that is how you proceed. So that is what happens. I don't know if that is the clarification you needed on statement changes in equity. Macklin, is that helpful?
Yes, it is. Thanks so much.
Okay, welcome. Ankunda Precious says, I'm requesting for an objective question. Now, we have certain questions in the question bank. I don't know if one of you could have a copy of them. I think there's one WhatsApp group where those objectives were shared. I must have shared them in one of the WhatsApp groups. So if you have them, you share them on the group. Now, if you want to see how these objectives are handled, I did a free video. I did a video on my YouTube channel, and that video can give you how you can answer some of some of those objectives. Let me just try to guide you here a little. You can try to run there. It's the channel is called Counting Coach. I'll share the link, or if you have the link, you can share. So there are objectives. I did some objectives partly in this channel. Okay, objectives. Yes, the objectives here. So I did objectives here. So you try to go through this session. It will give you an insight on how we basically handle the objectives. Okay, save for these adverts that come in. But you'll be able to get an idea of how we handle the objectives. One thing that I'll comment about when it comes to the objectives, definitely, of course, we know very well there are usually 20 of them. But you need to, you don't need not spend a lot of time on them, okay? And one thing that I usually tell, and again emphasize, that one of the things that is going to make you pass this paper or have to repeat it is the aspect of time management. So most students, again, take time to focus a lot on objectives. They end up spending a lot of their time on the objectives. Treat the objective as a number on its own. Now, like, we understand very well that the paper has 3 hours, and 3 hours translates into 180 minutes, okay? 180 minutes means that you should spend ideally 36 minutes on every question. Now, objectives, because they have 20 marks, are more like a number on their own. So make sure that you don't spend more than 30 minutes on the objectives. So that would be like 1 minute per objective. Now, there are some objectives that will require you to calculate. Now, those objectives that require you to calculate, make sure you also not spending a lot of time, because you're looking for 1 mark. And the examiner doesn't want formulas, doesn't want your workings, is not looking for such. So you don't have to provide all this information. You just have to make sure that all you're looking for is the answer. So if you can press this thing off the calculator without even having to write it down, well and good. If you can write it down very fast. You don't even have to draw up the ledgers and spend a lot of time there. Make sure you understand that you're only looking for 1 mark on those objectives, okay? And the best way to pass objectives is to do several questions on objectives, by the way. Not even to pass them, but to get used to them so that you don't spend a lot of time on them. It's to look at several questions that have objectives. Now, I know the iSPA website does not have objectives, but I said there are those notes, not notes basically, but there's a handout that we circulated on the group. I think if I'm to get it, then I'll share it with either the admin, and then we share it so that you take time to go through some of those objectives. At least go through objectives for the last maybe 3 papers or whatever it is. They may not be recent papers, but these objectives are usually the same. And for it also pass these objectives is read text. Now, most of us are doing a lot of calculations during this time, but I would encourage you, get down to the notes, understand the concept somehow, because the examiner, sometimes they are testing to your clear understanding of, you cannot cram and say, this one, whenever I get a provision for unrealized profits, I'll list it in the state, because it will vary. So when you go through the notes, they help you give you a picture of why we do things a certain way and what happens when things are brought in another way. What do we exactly do? So that's what the notes help. And I shared with you a detailed handout with several topics that is detailed. So if you've not looked at that handout, I'd encourage you to basically look at it, okay? Yeah, so that is very important. I just wanted to clarify. So you can get that link. If any of you has it, can share it in the WhatsApp group so that others can get it. That website has other videos that I've done. Some of them you might have access them in the recordings, in the other file for recordings, but make sure that you look at them, okay, as well, and see how those can help you accordingly. So that was the only other question that I see here. I don't know if there are those people that joined us late. Basically, I chose to start by looking at questions or areas of challenge that you currently have. Now, one of the things that I want to encourage you is that you have all it takes to pass this paper. And I've taught different students who have been able to pass this paper, despite even the break that we have had. Actually, the break we have had was to help you conceptualize all that you have, to make sure that you understand that this is your responsibility. And when this paper faces you, it will face you as an individual, because we can have these revisions over and over time. Sometimes it can even become information overload to you, okay? But when you get down and try out some of these things by your own, because like I said, one of the other things that helps you to improve your speed in the exam is trying out this question. Create an examination-like environment. What this helps you is it even trains your hands to be able to write for long. Some of you have never written for over 3 hours in the last 5 years. And when you get to the paper, your hand is lazy because it struggles. It's just like a marathon. If you've never taken a marathon in the last 2 or 3 years, or even in 6 months, you will struggle through. So that's why I encourage you, get that question. Right now, you should get to a question paper and be able to attempt 5 questions and more. So get a question paper, try out a number, time yourself, and make sure you finish that question in 30 minutes. Even those that are going to the exam, you can choose actually to go with either your watch, so that can help you with time. In case it's not that, look for maybe a clock within the examination room where you can look and be able to time yourself. Don't spend one hour and a half on a question when you have different questions where you can earn several marks. One of the things that I did continuously comment on in the classes that I had was the aspect of, when you get to the examination room, don't be there trying to balance off, trying to get the totals. First, work on earning marks from the entries. Make sure that you get all the marks on the entries, and then after that, that is when you come and balance off and try to make sure that the question, whatever you've put is okay. All that. Don't be there and take a lot of time. The numbers fail to balance. That stresses you, yet you can get several marks on other questions. So time management is very key, and it's something that you can use in these last days to also practice and make sure that you understand, you get it. So that is very, very key for us. So I don't know if, apart from the questions that came through here, does any one of you, maybe you've not been able to type, I can allow you to unmute and try to ask any questions that is not on partnership, because I want to handle partnership as a topic on its own. Anyone, you can unmute and ask. I want to give you clarifications on some of the areas where you have challenges. Please don't be afraid to ask when you have the opportunity. Yeah, I'm a bit not active on WhatsApp, so you might have shared a question or anything that you're seeking clarity, so you can use this platform to ask. And then I'll be able to give you an insight. As I give you, I know more other people are also able to learn through as well. Okay. Yeah, so I think it's very good that we have the confidence. Okay, I see there are no clarifications. I believe that we are somewhere when it comes to our preparation. At least we have looked at the topics, bank reconciliation. If any question comes on bank reconciliation, I believe that there is no any challenge right now on bank reconciliation. I believe there is no challenge on suspense accounts, correction of errors. I believe that everything is okay because I've not gotten any question on that area. I believe that nanny for profit, we are all fine, even when it comes to drawing up a subscription account, dealing with unpaid subscriptions, accrued subscriptions, prepaid subscriptions. I believe we are very fine in that area. I believe that we are okay when it comes to the cash book, ledgers, the accounting equation, drawing up of financial statements, as well as drawing up financial statements for single entry organizations that don't prepare financial statements. I believe we are okay, all that. But if you have a challenge, please use the chat box, or you can unmute and be able to ask, and then I'll be able to help you accordingly. Okay. Yeah, so that's at least by the time you go to the exam, you're somewhere. So as the question comes through, just to highlight that we had a class on partnership, and the class on partnership was mainly around aspects of how to prepare financial statements for partnerships. Okay, so we didn't go into cases of changes in partnerships, which is also a key area that you need to be able to look at, because sometimes the examiner may not ask you just to prepare financial statements for partnerships. They can also ask you to cater for changes in partnerships. Okay. Now, we know very well that partnerships, some of the changes of definite that can happen to partnerships is partnerships can admit a new partner. They can also go ahead to wind up. Okay. And in most cases, when they admit a new partner, they do what we call a revaluation of their assets. They revalue their assets. And when they closing off their partnerships, we have what we call realization. So we have the aspect of revaluation and we have the aspect of realization. Now, this one usually confuses students of how to work with accounts of revaluation and also work with accounts of realization. Now, one thing that we need to understand is when it comes to the revaluation, we are basically revaluing our assets. Okay. Now, revaluation for assets also happens for the private sector where we don't have partnership, but it's more of assets increase their value. So if let's say motor vehicles at 2 million, it can be revalued maybe to 3 million. So there's that difference. And then when it comes to realization, realization is more of selling, because when partnerships are closing down, we are basically selling off, let's say, the assets, and the partners are able to share the proceeds. Okay. So those two different concepts have a different way of how we handle them. Okay. Now, I wanted to use, given the timing, I didn't want us to just go into the class teaching. I wanted to use a question, a past paper question, so that you can be able to understand this in a much better way, because definitely right now, our focus should be on the questions. I believe you've tried to read some of the text. Okay, so our focus should be on questions, and also questions which we are not going so much in detail of the questions, because I believe that what you need right now are insights to help give you where to start from basically. So let me just try to get one question here. But for the meantime, as I get the question again, in case, apart from the topics that we have, that I want to look at, in case you have any challenge on the previous topics, other topics other than, let's say, partnership, then you can be able to ask, and then I can be able to clarify on that. I usually encourage students that despite you looking at what you've not covered, make sure that what you have covered, you have all the confidence that you know it all, okay? Because even if they bring anything, let's say on any topic that you have covered, yours is to make sure that you maximize the marks, that in case there's anything that challenges you, any question that challenges you, it cannot make you fail a paper. At least you're somewhere along the journey of passing, okay? So that is one thing that I would really want to say. And I usually say that as you go to the exam, have that kind of confidence where you say that at least for each of these topics. And right now, since the exam is around the corner, at least for all the topics, you should have the confidence to be able to do what? To be able to pass any question that might be brought. Anyone has come across a question on partnership that can guide us? Which year that is? I'm trying to look for one on either evaluation or realization. I'm trying to look for one, but I can't easily locate the question because there are several papers that I do have. Anyone tell us which year they set revaluation or realization? Okay, Joanne says.
Mr. Samuel, there is a question in October 2021. It's about revaluation.
Okay, thank you.
Yeah. It's question 5.
Okay, you're saying October
2021, question 5.
Question 5, yeah, we can look at that, October 2021, question 5, and then there's one that has been shared in the chat box for realization. Let me just try to get that one. Then we can look at it together. And then we see, at least make sure by the time you go to the exam, you at least aware of those two elements, in addition to definitely every other topic that we have at hand. And make sure that you reference back to the course outline as well, to just make sure that you've covered everything there. In case there are notes or any information that you've not gotten, you can always be able to get it, including entrepreneurship. Okay, there's one handout that I shared about entrepreneurship. I know that most of the text is something that you can easily read and conceptualize. And even when you look at some of the past paper questions, especially around that topic, you should be able to see that this is not, these are things that are not complicated. It's basically normal running of businesses, okay? For example, them setting you a question of saying, what are some of the challenges that are being faced by businesses today, post-COVID, after COVID, or what are some of the risks that businesses face. So you need to look at such areas, challenges of businesses, aspects of risks, aspects of understanding entrepreneurs, the different forms of entrepreneurs, okay? That handout can give you an insight, but also look at the previous questions that they have set. They'll give you guidance, and then also look at the course outline to give you the key areas that you should research more about. So October, okay, I think I put in October. Okay, so I believe that this is question 5. Did I get it wrongly? Was it October 2021? Question, this is March, sorry. I think I opened one of March, said October. Okay, yeah, so I believe we are here, October 2021. So this question, as you can see here, they were asking us to prepare for Hannah, Penina, and Sarah partnership, revalued individual asset accounts, revaluation account, goodwill account, capital account, then they want the adjustment of the statement of financial position. So just read through the question, I'll run through a little, and then Hannah and Penina in partnership, sharing profits and losses in the ratio of 3:1. On 1st January 2020, the partners agreed to proceed as follows. So they are admitting a new partner, Sarah. Now, one of the things that you need to take from here, like I've told you, that revaluation comes in when a new partner comes on board, okay? So we have goodwill coming through, but also we have revaluation happening. So they're telling us value goodwill at 150 million at the time of admission of Sarah. And then we're supposed to revalue our non-current assets accordingly. So they're telling us that the partnership statement of financial position as at 31st December 2020 was presented as below. So we have land, which is 150,400, buildings, motor vehicle furniture, and so on. So this is what we have as at 31st December 2019. So this is post, before we bring in the partner, because remember we agreed on 1st January 2020. So before we brought in the partner, these were our assets. This is what we had. So they're giving us a balance sheet, our statement of financial position, and it goes down until down. Now, additional information is telling us that on 1st January 2020, when they admitted Sarah, she contributed a capital of 60 million through the partnership's bank account. Hannah, Penina, and Sarah agreed to share profits in the ratio of 3 to 1 to 1. Now, one thing that you also understand is that whenever we admit a new partner, the ratios will change definitely, because if they are sharing 3 to 1, they were 2, there needs to be a new profit sharing ratio, which will always be provided to us right here. And then they are also telling us that the assets were revalued. By assets being revalued means that the asset, we've looked at the value of the asset. For example, land is now 206,500, but what was the value previously? From here, we see that land was 150,400. So it has now gone up. Most likely, the assets usually go up. Buildings is 296. Previously, it was 230, okay? And then we proceed. Furniture is also that, and then they give us inventory, that value. Then they also proceed to tell us that on admission of Sarah, goodwill was introduced and accounted for using the memorandum revaluation method. And then they're telling us the partners maintain their accounts using the fluctuating capital balance method, okay? So we are trying to see terms here that you need also to basically understand, okay? What is fluctuating, what is floating, and so on, and how would that impact even how we calculate our question. So we proceed here. We have, they're asking us to draw up the revalued individual assets, 6 marks. They want us to draw up the revaluation account. They also want us to draw up the goodwill account. They also want us to draw the capital account, as well as the adjusted statement of financial position after admission of the new partner. Remember, we have the statement, this statement of financial position. So we have to change it. Remember, where there was land was at 150. The adjusted statement of financial position will not have land at this value. We'll have land at the new value of 206,500. The same thing will happen with the buildings. Same thing will happen with the motor vehicles. The same thing will happen with the furniture, and the same thing that will happen with the inventory. Now, just like the way we have it in private sector, revaluation, when you're looking at revaluation is increase in the value of the asset, okay? Revaluation is increase the value of the asset, and here we're trying to look at, we debit the asset. Why we debit the asset is because the asset is increasing in value, okay? The asset is increasing in value. And then we credit the revaluation account. We usually credit the revaluation account. So when they ask us to draw accounts for each of the assets, definitely we have to do the T accounts, okay? So for example, let's say maybe we are doing the T account for, let's start with the one of land. So let's say maybe this was land account. Okay. Now, this land account will have the balance brought down. Basically, the balance that is within the statement of financial position as we have been provided. So land has a value of 150,400. So right there, okay? And it's being revalued to a higher figure. So the revaluation amount, we are debiting the asset and crediting the revaluation account. So we shall have revaluation. Now, we see very well that the original value is 150. Now here you press your calculator, and the value at which this is being revalued to is 206,500. So 206,500, when you get it, 206,500 gets you 56,100. So your revaluation amount is right here is this 56 that. Now, as you have your land account, remember you have your revaluation account. Which revaluation account we are doing as a general account. So let's say I'll draw mine here. Okay, so as we put here the 56,100, this same amount will go to the revaluation account on the credit. And I'll come and put here land. I'll say land. So I'm going to do that for all the assets. Okay, I'm going to go and do that for all the assets until I have revalued all of them. Okay, now as you can see, they mostly looked at the non-current assets. Those are mostly the ones that we revalue. Now that revaluation is not in any way even different with the one we do for the private sector. I know sometimes the examiner might want to bring you, might want to comment or bring in something of revaluation when it comes to questions of depreciation, okay? You know those questions where they bring you different assets that were bought at different times, and then they're asking you to go ahead to draw up the depreciation account, accumulated for depreciation account and disposal account. Now, in such scenarios, you can have cases of where you have depreciation. You can have cases where you have depreciation after revaluation. So definite depreciation after revaluation is based on the revalued amount, okay? So that case, scenario is also there, okay? That scenario is also there. So you need to check it out and see how to basically handle it, okay? But it's not complicated. It's something that you can easily do. It is something that you can easily do. So after we've drawn up those respective accounts, because you're now going to draw up them, I'm not going to draw them up. So you draw up for each of the assets as provided to you. We shall draw up a buildings account, we shall draw up a motor vehicle account, we shall draw up the furniture account, then we shall draw up a inventory account. Like I told you, the principle is start with the balance brought down. And that balance brought down is what is within the statement of financial position provided to you, and look at the revaluation. Revaluation is the difference between the other value that was in the statement of financial position and the one that they're telling you is the revalued amount, okay? That gives you exactly what you need to be able to consider, okay? Yeah, so that is very important. Now, once we've understood the aspect of, because these are easier to do. Right now, we've done these two values, revalued as individual asset account as well as the revaluation account. You can see that these are more like free marks because you're not going to take a lot of time on those things. It's this directly data entry from, you just pick information from there, you put it to the other side, okay? Definitely, of course, one thing that you need to understand is the revaluation account is usually balanced off. And we usually get what we call a net gain or loss on revaluation. Okay. Now, one of the things that you need to understand is just as we take, because we've taken that amount into the revaluation account, you're going to have the total revaluation. Okay, so that will be more of a gain or loss on revaluation. Now, I want to comment on when it comes to the goodwill account. Okay, goodwill account. Now, goodwill, as they have asked us here, because they have asked us to draw up the goodwill account. So goodwill account, just come here. In case I leave something and it's not clear to you, then you can still highlight that for me. Okay. So goodwill account. Now goodwill, like we have seen, that one of the things that the partners agreed, okay, on admission of a new partner was the aspect of bringing about goodwill. And that is highlighted here. And they're saying that value goodwill at 150 million at the admission of Sarah. Now, when you're looking at the goodwill account, and here the examiner is trying to look at aspects of, we're trying to look at what is the old sharing ratio vis-a-vis the new sharing, vis-a-vis the new sharing ratio. Now, one thing that you need to understand is from this information, they have given us that the old sharing ratio is 3:1. So 3:1. So means that if we have two partners, we have Anna and Penina. Okay, I'm going to repeat on that, but you can also utilize the recording, because I'm trying to record this, so you can easily, I'm going to share the recording so you can easily play back. I know other people also interfering internet challenges, so you can play back to get the information that we can cover something. I know time is also not on our, it's not on our side, but we shall run through. So we have the total ratio is 4. So means that this is this one is basically 1 divided by 4. Okay, so giving me this. Let me just try to change it in a number. This should be general. 1 divided by 4. Okay, let me do this. This you can do on your calculator. Shouldn't disturb you much. So 1 divided by 4 is 0.25. Because total ratio is 4, and means that this will be 3 divided by 4, which is 0.75. Okay. So what that means is we are now going to look at before admitting the new partner and after admitting the new partner. So what we have, the partners, remember, agreed on a given what? They agreed on a given goodwill. And the goodwill they agreed was 150 million. So your goodwill account will have a share of this 150 million before admission of the partners, of the new partner. So you're going to debit it with the share of this 150 million amongst these two guys. So I'll put a degree of precision here, very important. 1,000. So these amounts are in 1,000. Remember, you can put it on top or you can put it here and also here. So Hannah, from what we've been given, because it's Hannah and Penina. So Hannah is sharing the 0.25 because, okay, I think I interchanged. Just if it's 3-1 and it's Hannah and Penina, then it means that this one will have the 3/4, and then this one will have the 1/4. Okay, if that is the narrative, because say Hannah and Penina share 3-1 respectively. So it's 0.5, 0.25. So what this means is that this will be 0.75. Now you don't have to do this on your examination paper. You just calculate and put it there. But I'm calculating it from the same sheet times 150,000. So you have 1,125,500. And for Penina, you also calculate this from your calculator, 0.25 times 150,000. I'm using 150,000 because I've already put the degree of precision of 1,000, so I'll have that. So that is what I'll have. After that, I'll look at now the three partners. So I'm going to look at Hannah on the credit side, because this is the debit side of your goodwill account. So again, I'll look at on the credit side, I'm going to look at how this is shared amongst the three partners. So the other new partner is Sarah. So I'll just add Sarah's name here. Remember their ratio has changed. It's now 3. They have told us it's 3 to, let's just see. It's 3 to 1 to 1. So that is the new sharing ratio. So based on that, we are going to be able to share our goodwill. So this is 3 divided by, now our total ratio will now be 5. So Hannah will have that, Penina will have that. So this will be 1 out of 5. This will also be 1/5 for Sarah. So after getting that, we are now going to look at what happens on the sharing of the 150, okay? So this is 0.6 times 150,000 gives us this. Then this will be 1/5, which was 0. We got 0. It's 0.2. 0.2 times 150,000 gets you that. Then that will be the same thing that will be here. It still adds to the same total. Now you're going to realize that we are going to have the same total, because it's just a presentation of how how goodwill will be shared after two company, like after another partner joins in. So that is what we basically have here, presentation. And this is basically what the examiner expected you here. But I just want to comment on something here. And within this, you get to realize that there is no, okay. There is something here that the examiner brought up. It's called memorandum revaluation method. I don't know if any of you has maybe read about this. maybe has any one of us read about this that can would want to share with us what this means? Maybe just to test and see if some of you have done some research. Anyone knows what that means? Memorandum revaluation method. You can unmute and tell us. Okay. You're saying? We can't hear you.
No, they will hear you.
The memorandum revaluation method, it means that the goodwill will not be maintained.
The goodwill will not be maintained.
Yeah, so after preparing the goodwill, we shall write it off.
Okay, very good. A very good explanation. When you look at what we have done here, you get to realize that there's no balance for goodwill. I don't know if you get to realize that, because what is on the debit side is actually on the credit side. So the revalue, we have to, okay, we actually have three methods. We have one method that is called the revaluation method. Then we have the memorandum revaluation method. Then we have what we call the premium method of treatment of goodwill. Okay. Now, when it comes to the revaluation method, here in this method, of course, a new partner does not bring in cash for his share of goodwill. And in this case, goodwill will be, we shall have goodwill raised in our financial statements. So we shall actually have a goodwill account in our books of accounts, okay? That is a case where we have the revaluation method. Now, when it comes to, for the memorandum, like the way she has brought it up, in this case, we have seen that the partner has actually brought in an amount of money, because they have valued goodwill at how much? At 150 million. So in this case, you don't have any amount of goodwill, okay? So in this case, what we have seen, that goodwill is raised based on the previous sharing ratio, and it is written off immediately by how the partners will share this goodwill. So goodwill is not basically maintained. So that is what the examiner indicated here. So if the examiner had used, let's say maybe talked about of the revaluation method instead, okay, then you would now have to think it from the other perspective. But if it's memorandum revaluation method, then you don't have the goodwill account, okay? So that is the same thing. Sometimes they can say goodwill was introduced, but the partners choose to write it off. Sometimes they may not say specifically goodwill, they may not specifically tell you this method, but they can tell you that the partners don't keep goodwill in their books of accounts. So it's the same thing that will happen in that case, okay? So that is why we have drawn up our accounts like so, like our goodwill account. That's how we have drawn up. We've had how they would share here and then written off the other side. So that is how you take it. Maybe also, like I said, goodwill is an intangible asset. So under the revaluation method, we need to understand that, of course, goodwill, like we've said, will be shown in our books of accounts, and it can be included within our what? Within our intangible assets. And then here, definitely where we are using the memorandum, we shall not have anything of that in our books of accounts. So that is what I wanted to comment about. And I think somebody asked, one of the people that joined in earlier on asked, when do we take goodwill to the statement of financial position and when not? So depending on the method we are using, that is what exactly happens, okay? Now, one of the other things that I would also say, maybe, I don't know if we can get a question that can give us that idea, but I can first leave that at that, and then we can try to see how the capital account looks like. You can see here goodwill was given 2 marks. So let's see how the capital account would look like in this case. Remember, there was a contribution of capital by the new partner, and even the old partners also had previous capital balances. Okay. So now, when you're looking at capital, remember, there are now 3 partners, but there were 2, okay? So they also asked us to, there's again another term that they brought in when it comes to capital, which is also good for you to understand. They say that they are using the fluctuating capital balance method. The fluctuating capital balance method. I believe that, I think I've commented on this in the class. Anyone wants to try on this one as well? Maybe another person other than one who has just told us about the memorandum. Anyone wants to comment on the fluctuating capital balance? Don't be afraid to present your answer. Anyone unmuting to share with us? Okay, as somebody comes through, I want to say that fluctuating capital balance method, we have 2 methods, and one is called fluctuating. Sometimes they may also call it floating. And then we have what is called the fixed capital method. Now, if you're using the fixed capital method, capital is only used to record, the capital account is only used to record the contributions, the capital contributions by the partners. If you're using the fixed capital method, that account only records only the capital contributions by the partners. If we are using the fluctuating method, in that case, we include both. We include 2 things. We include both the contributions by the partners as well as the details that would have included in the current account. And that means that for the fixed capital method, we actually have a current account. We shall have 2 accounts. We shall have the capital account and the current account. But for the fluctuating, the capital account is a mixture up. All the details that go to the current account are put into the capital account. So the capital account is a general account that records the contributions by the partners, but also records other items like goodwill, things like if we had things like interest on capital, if we had things like maybe interest on drawings, salaries, it would be able to record, okay? So in this case, since they told us to use the fluctuating, means that we shouldn't have a current account. All the details that would have gone to the current account should be put into the capital account. So our capital account should be a general account, okay? Should be a general account. So what that means is that we should now have, now capital account, we are going to draw it in a way that because we have now 3 partners, we are going to have 3 columns. We are going to have 3 columns. Just a moment. So here we have Hannah, we have Penina, then we have Sarah, right there. So we are going to have all those columns on the debit side and the credit side as well for our partners. So definitely, of course, this first part, like any other account, will have the details. Can put them here. So the same thing will also be this. All right, so I was just trying to show you this for the internet dropped me off. So in this case, remember they from the information they have given us, we are drawing up the capital account, but this is from the information we have. Now the capital account they have given us, there's something that is we have in the balance sheet, definitely. Like I said, if it's a fluctuating capital method, even here we shall only have the capital accounts. We shall not have, under equity, shall not have a current account. So these are the capital contributions for Penina and Hannah, okay, as per the balance sheet. And those are going to be our balances brought down. So when you come here, remember capital has a normal credit balance. So you're going to have your balance brought down here on the credit side, and I'm going to put the respective amounts as they are. We have 205. That, then Penina has 300. That. So that is what I'll basically put here, okay? So these are balances. Before we even admit a new partner, this is what we started with at the start of the year, before any decision came through, okay? Now, we know very well that there came a new partner, Sarah, okay? Now, Sarah, when it came through, Sarah contributed a capital, but the partners also agreed to introduce goodwill into their books of accounts. Okay, not in the books of accounts, but they agreed on goodwill of 150 million. Definitely it didn't remain in the accounts because they are using the memorandum revaluation method, okay? But what that means is, remember when we were preparing our accounts, goodwill account here, we debited goodwill with these values. Now, as you debit goodwill here, using the previous sharing ratio, you're supposed to credit the capital account for the respective partners. So basically come here and say goodwill and copy these amounts as they are. This here, this here. So it will be like that. So that is what the debit will be. Now, in the same way, the way I credited, as you credit here, the new sharing, how goodwill is being shared by the new sharing ratio. You come and put this on the debit side. This is the double entry. Like so. So I believe you can observe that the double entry for the sharing of goodwill using the old sharing ratio, you debit the goodwill account and credit the capital account. Sharing goodwill using the new ratio, you credit the goodwill account and debit the capital account. That is how that is done. Now, after you have done that, one of the things that we need to also look at is, remember, we have capital contributions. We have a capital contribution by our new partner. When you look at the information we have here, when you look at this information here, okay, where? I want to see Sarah's contribution. Sarah contributed a capital of 60 million into the partnership bank account. So you have that capital contribution for Sarah right here, 60,000. Right there under Sarah's column. So going forward, Sarah will have that capital balance. Now, one of the things that you also understand on whenever we have a revaluation, you saw our revaluation account. This revaluation account, after you have looked at your revaluation account and balanced it off, okay, you get your so-called revaluation gain. You get a revaluation gain here. The total that you get on this account, the balancing figure. Now that figure is supposed to be shared among the two partners, Penina and Sarah, because Penina and Sarah are the ones that worked for those assets in simple man's language. They worked for those assets basically before Sarah came through. So that so-called revaluation gain, of course, definitely is usually a revaluation gain. That revaluation gain is also brought here and shared among these partners. Like I said, this is supposed to be shared based on their previous sharing ratio. Revaluation gain is shared. So we've not calculated it here, but in case you calculate it, you can come and share it using the ratio of 3:1. After you have shared that ratio of 3:1, you now balance off your capital account to determine your balance carried down. Now, the reason why you determine your balance carried down definitely is to balance off your capital account. But remember, one of the questions was requiring you to redraw the statement of financial position in order to present it. So it means that when you come to your new statement of financial position, because that is one of the last parts, adjusted statement of financial position. What you're going to do is, like I told you, these land, buildings, motor vehicle, furniture will have new values, and those new values will be as per these values. When it comes to, definitely even inventory has a new value. Fees receivable, this one remains not changed. Cash at bank, you see if there are any changes in cash and bank. Remember, this one contributed 60 million. So does it affect your cash and bank? That is something that you look at. If it affects your cash and bank, you go and adjust it, because the 60 million is added to the 43 million. So your cash and bank will be adjusted by the contribution of the partners. Now this goodwill, they are just valuing goodwill of 150 million, but in reality, it doesn't mean that this is money that is coming through or cash. It's just a valuation. So that one doesn't affect your cash and bank. Now, equity, total liabilities and equity. Under equity, you now have the capital balances that you have for each of those partners. Whatever balance you have as your balance brought down, carried down here, will now be your capital balances. Remember, as it's balance carried down here, it will be balance brought down this other side, because capital has a normal credit balance. So you put your capital balances here. Non-current liabilities does not change. You have the bank loan there as it is, does not change. Trade payables has not changed, and you think we'll be able to balance. Hope you've raised your hand. You can unmute and ask.
Okay, okay, my question is about goodwill, treatment of goodwill under the capital account. Suppose it was a new partner that came in with a goodwill. For instance, if it is, for example, like if Sarah contributed 42 million as goodwill, and then this value was credited under Sarah's account in the capital account. So how do you treat that in a capital account?
Okay, so you're asking, what if there was a goodwill contribution by the partner?
Yes, but it was credited as Sarah, as the new partner's contribution. So when after opening a goodwill and then you've done all the sharing, how would you treat it in a capital account?
Okay, I hope I'm trying to get what you're trying to ask. When it comes to, okay, like I said, we have different cases of how to account for goodwill, and like I gave the different methods we have. Now, when we have a case where goodwill remains in the books, okay, in that case, we'll have, when it comes to the capital account, especially for the respective partners, definitely, when it comes to sharing of this, of course, we understand that goodwill in this case will actually appear in our books of accounts as an intangible asset. Now, when it comes to how it is shared amongst the partners, it will still be based on, we'll look at the profit sharing ratio. We shall still be able to use the same basis of how to share. And the key principle when it comes to the capital account, whenever we are looking at the capital account, we look at it from the perspective of benefit. So we look at it from the perspective of benefit in a way that every time the partners are benefiting, we usually credit their account. So when a partner brings in goodwill, it's the partners that are existing in the partnership before this new partner that share this goodwill that has been brought in. I don't know if that helps.
Okay, partly, but okay. The situation is actually this was goodwill, and it was not maintained in the books of accounts. But I think there were they made an error and recorded goodwill as capital contribution for the new partner.
Which question is that?
Question, I don't remember, but I encountered it. Either it's in the textbook or in the question papers. But it was like an error. Goodwill was recorded as capital contribution.
No, it if it was recorded like that, definitely was recorded in error, because goodwill is not capital contribution. Okay.
Yes.
Goodwill is goodwill, and then capital contribution is as is.
Yes. So if you encounter that like in a question, how do you deal with it? Like,
where they treated goodwill as capital?
Yes.
I think unless like I don't know how they would make an error in the question and treat it as goodwill, like or treat goodwill as capital, because in most cases they'll give you the goodwill value, just like the way this question they have given us goodwill up here, and all they want is you to how to account for the goodwill. You get it?
Yes, it was given in additional information, like it was given in additional information that the goodwill was recorded as capital contribution in the capital account.
So they were telling you that an error was made. They even indicated that it was an error that was made.
Yes, yes.
And then they were asking you how to correct the error. Was it a suspense account?
No, they asked to prepare a capital account.
I think in that case, they were trying to look at, see if you understand how to treat goodwill, and then you correct. Because if they have already told you the error, then you now have to do the correction of the error, just like the way we use the approach when we are correcting errors in the suspense accounts. But in this case, you definitely remove it from, if they had credited the capital account, to remove it from the capital account, you now debit your capital account. You get it, eh? As you credit your capital account, you debit your goodwill account.
Okay.
You get it,
so,
eh?
Yes, I get it. Where I found an issue, because the goodwill was not maintained in the books. So already we wrote it off by sharing, using the new profit sharing, which means also Sarah had a contribution on the debit side, the respective contribution, because when we are writing off goodwill, we credit in the goodwill account, and then we debit in the capital account. So if we are writing it off, how will it match with the respective balance on the credit side?
By you saying in the goodwill account?
Yes,
or in the
capital account, in the capital account, because goodwill was written off, like the number we have, the example we are using here. So if we are to write off the value that was credited wrongly, it means we shall debit it again. If that is what I'm thinking.
Okay, what you do, if in this case goodwill is not maintained in the books, as you remove it from the capital account, You're now taking it to, I don't know if in that case they had, because some cases, they have done the right thing in the goodwill account, and they have not done the right thing in the capital account, because right here we saw that the double entry happened between the goodwill account and the capital account. As we were recording here, we went ahead to record these values even in the capital account.
Yes.
And then also if we
Another thing,
yeah, so what I was saying, Hope, that just in case you get the question, you can give me a call, and then we can look at it. Or what you could do is tomorrow we'll have a similar session, so you can bring the question tomorrow, and then maybe I can comment on it well when I'm looking at the question. Is that okay?
Yes, that's fine.
Okay, fine. All right. So for this, what we have done, apart from Hope's question, do we have any other question on this or on financial accounting? I'll try to hand a question tomorrow on realization. But also in case there is anything that you come across around the revaluation, then you can share the question tomorrow, just like Hope had. You can share it prior, maybe on the WhatsApp group, so that the rest of the other students can also look at it, and then we can look at it tomorrow. Then also, if you have a challenge also, I use the first minutes to look at areas where you have a challenge, anything that you need clarification to. I'm able to go it through so that we can learn together. So for now, do we have any question? If you have, you can unmute and ask, or you can use the chat box, and we can call it a day. Okay. Yeah, but like I said, don't spot the examiner. There is nothing saying that this topic was not set last time. So I should do something. Yes, you're asking? Precious?
Excuse me, sir.
Please use it.
Good evening, everyone. I was trying to ask, like, I also met a same challenge when I was trying some questions in the study pack. I think it was question 3, partnership. Question 3.
Which
it had
year?
some errors. Wanji?
Question 3?
Yes, partnership in that book.
The study pack.
Yes.
I don't know. I don't have the third study pack. Maybe those that have the study pack can. Yeah, but one thing that you need to, good you're able to realize that it actually had an error. I've not seen the question, but definitely people that prepare those study packs are humans, and somebody can prepare the study pack, but the people that even type the study pack to translate it into the material that you use can miss out some of the things, or they can, instead of typing goodwill, they can type capital. So that can exactly happen. But as long as you know that you understand the principle, and you can even look at, let's say, past paper questions and see how these were attempted, and you see that that is the right approach, then you should just have the confidence that this is the right direction. The study packs are not like this is what iSPOW fully like is going to take. If you believe that that was an error that they made, then you go with that, and when it comes in exam, then you do the right thing. You get it, eh? So that's what I can basically comment on that. If you're able to pick up the error, that is well and good. Okay. For that question 3, unfortunately,
No,
I don't have a copy.
Sir.
Yes.
The challenge only came like when when these people were posting the goodwill accounts as capital accounts, it was so challenging because we failed to understand where the figures were coming from.
You failed to understand how they were coming to the figures.
Yes.
Okay. What you do, you if you have the book, you take a picture and post on the WhatsApp group, and then maybe you can also post the solution where what exactly is you're not getting, because I don't have a copy of that. Maybe you can try to figure out and then give you some guidance and see what they are trying to derive at. Okay.
Okay,
and then maybe I can comment on that maybe in the next class.
Okay, sir.
Okay, fine. Kali,
Thank
thanks to you all for putting in some time to be here. Let's look at this tomorrow. I'm going to share this recording to those that had challenges of internet, like Brenda, and like to Jovia that joined in a little late. Okay, have a good night. Bye-bye.